Welcome to Wealth Horizons, where we know wealth is more than money. It includes your health, independence, well-being, and freedom to make your own choices. In videos 1 and 2 of this series, we examined index funds and actively managed retirement income funds. Today, we discuss 7 lower-risk options seniors can research for income, liquidity, and capital protection. Be aware that no investment solves every retirement problem. Something that protects your balance may lose purchasing power to inflation. Something paying more interest may lock up your money. And an investment guaranteed by a private insurance company is only as strong as the insurer behind it. This video is for education purposes only and is not financial, investment, tax, legal, or insurance advice. Be aware that interest rates, taxes, insurance, and product terms can change. Carefully read all disclosures given to you and consult your qualified financial advisor before making a decision. Your first option is a high-yield savings account at an FDIC-insured bank or an NCUA-insured credit union. There are 3 reasons this type of account is on the list. The first is liquidity. Because this is a depository account, you can readily access your money, although there may be some required paperwork for large cash withdrawals, and the bank may give you a cashier's check rather than cash to fully document the transaction and to satisfy regulatory requirements. The second reason is federal deposit insurance covering your money when both the institution and your account qualify and your deposits remain within the applicable parameters for the account. Third, a variable interest rate CD may provide a better return than a traditional low-interest savings account, and sometimes a deposit-hungry bank or credit union wanting to increase its own capital will offer above-market rates in order to attract depositors. The standard federal deposit insurance limit is $250,000 per depositor per insured bank for each ownership category. Multiple accounts with the same ownership at the same bank are generally combined when calculating coverage. Your banker will know how to facilitate higher deposit amounts so that your money is covered by deposit insurance. Of course, interest rates can fall at any time, or there may be a time limit for the special rate, and inflation may exceed the interest you receive. The second option to consider is a certificate of deposit, or CD, with a bank or credit union. There are 3 reasons this type of account is on the list. First, a CD generally locks in its stated rate for a defined term, so you avoid rising or falling rates of return during the same period. Next, qualifying CDs with a bank or credit union are covered by federal deposit insurance within applicable limits. And third, multiple CDs can be strategically staggered over time so that they mature at different sequential times, often referred to as a ladder or waterfall maturity strategy. Of course, the benefit of a fixed rate for a set term means you don't have ready access to your cash without paying a penalty for early withdrawal. Always verify the maturity dates, conditions for renewal, early withdrawal terms, and federal deposit insurance coverage. The third option is United States Treasury bills. Treasury bills are short-term federal securities generally sold at a discount and paid at face value when they mature. There are 3 reasons this type of account is on the list. First, they are backed by the full faith and credit of the United States government. Second, their short maturities can make them useful for money needed within the next several months or years. And third, interest from Treasury bills is subject to federal income tax, but is generally exempt from state and local income taxes. So, check with your tax advisor before you invest. Treasury bills can be purchased through Treasury Direct or a brokerage. If you sell a treasury before maturity, its market price may be higher or lower than what you paid. The fourth option is Treasury inflation-protected securities, commonly called TIPS. There are three reasons this type of investment is on the list. First, their principal adjusts with changes in the consumer price index. Second, their interest payments are calculated using the inflation-adjusted principle. And third, when held to maturity, TIPS can help protect a portion of future spending from unexpected inflation. Be aware that TIPS are not stable cash accounts. They are not covered by federal deposit insurance, and their market value can fall when real interest rates rise.
In a taxable account,
Inflation adjustments can create federal taxable income before the investor receives the principal at maturity. Plus, a TIPS fund has no single maturity date for the investor's shares. The fifth option is the Series 1 savings bond. There are three reasons that savings bonds are on the list. First, their composite interest rate includes a fixed component and an inflation component. Second, the value does not fluctuate in a public market like a traditional bond fund. And third, the interest is exempt from state and local income taxes, although federal taxes generally apply, so check with your tax advisor before you invest. Be aware that savings bonds cannot be redeemed during the first 12 months, and redeeming before 5 years generally costs the most recent 3 months of interest. Annual purchase limits also apply. The bottom line is that Series 1 savings bonds are a supplementary inflation tool and not a place to move an entire retirement account. The sixth option is a government money market mutual fund. There are three reasons this mutual fund is on the list. First, it invests mainly in short-term government securities and seeks to maintain liquidity. Second, it can provide convenient access to cash inside of a brokerage or retirement account. And third, its yield generally responds relatively quickly when short-term interest rates change. Be aware that a money market fund is not a bank or credit union account. Mutual funds are securities, not bank deposits, so your money is not covered by federal deposit insurance and it can lose value. Before investing, have your financial advisor examine the fund's holdings and expenses and determine whether it is a government, treasury, prime, or municipal money market fund within your applicable level of risk. The seventh option is a fixed annuity issued by an insurance company. There are three reasons this annuity is on the list. First, certain contracts can provide a stated interest rate for a defined period. Second, an immediate income annuity can convert a premium into predictable payments for a chosen term or for life. And third, lifetime payments can help manage the risk of outliving part of your savings. But be aware that fixed annuities are not covered by federal deposit insurance. Their guarantees depend on the financial strength of the private insurer and the terms of the annuity contract. Annuities may include surrender charges, limited access to principal, inflation risk, and reduced benefits for heirs. Have your financial advisor compare the insurer, commissions, surrender period, withdrawal allowance, death benefit, inflation options, and any state guarantee association protection. Never purchase an annuity you do not fully understand. How might these 7 choices work together? Do not begin by asking which one currently pays the highest rate. Rather, begin by asking when you expect to need access to your money. Bucket 1 covers immediate spending and emergencies. A high-yield savings account or carefully selected government money market fund may provide liquidity. Bucket 2 covers planned spending over the next few years. A ladder or waterfall of CDs or treasury bills can arrange maturities around expected expenses. Bucket 3 addresses later risks. TIPS and Series 1 savings bonds can provide inflation protection, while a carefully evaluated fixed annuity may cover part of a lifetime income gap. None of these should automatically replace the diversified stock allocations discussed in videos 1 and 2. A retiree may still need long-term growth to address both inflation and a retirement that could last decades. Always have your financial advisor compare 4 things: safety of principal, access to the money, protection from inflation, and income reliability. Confirm matters of taxes and penalties and what principal protection is provided. Federal deposit insurance, Treasury backing, mutual fund regulations, and private insurance guarantees are not the same thing. If you enjoyed watching this video, please like it, share it, and subscribe to Wealth Horizons. Tell us in the comments which risk concerns you most: market losses, inflation, running out of income, or losing access to your money. Thanks for watching.